In the meantime, back here in the U.S., the latest Fed report showing that deposits at small banks are stabilizing. Joining us right now to talk about the banking sector is Gerard Cassidy. Gerard Cassidy, I should say. He's the head of a U.S. bank equity strategy at RBC Capital Markets. Things look like they've calmed down, but I don't know how long they've calmed down for here. What do you think?
Good morning, Andrew. You're right. The numbers last Friday that were released showed that the outflow for deposits for the small banks was essentially flat. Now, granted, they were revised the prior week number, but still the flat number was very encouraging. And I think, as you pointed out, it's maybe a little premature to declare victory, but I think that the deposit flight is over. It's stabilized for the small banks, but the large banks, as you may have seen, also saw outflow, which is not uncommon for what's been going on with the Fed policy of QT.
In terms of the policy piece, though, on some of these smaller banks, what do you think has to happen or not? And do you think it can just happen through what the Fed does or doesn't do over the next couple of months to keep this sort of simmering under the radar?
It's interesting. It's an interesting question because when you take a look at what these two banks, Signature and Silicon represented, they were entirely different than your typical bank. And when you look at the smaller banks in this country, when I say smaller, less than 25 billion in assets, and you look at the composition of their deposit mix, they have 60 to 80% of their deposits coming from depositors with less than $250,000 in each account. And that was not the case at Silicon Valley. They had approximately 2.5% of deposits from those types of accounts. So it's a very stable deposit base. But yes, we're going to see the May 1st report coming out of the Fed and the Treasury about what happened. There will be some changes, no doubt, but it'll take some time. As you might remember, when Dodd-Frank was introduced, that was sometime in the spring of 2010. So it takes time before they can put new policies in place.
And as those policies get in place, though, how do you value these companies?
It's interesting because the stocks have sold off really hard, even companies that really didn't see the deposit flight that's, obviously Silicon Valley and Signature saw. So first quarter earnings, Andrew, will be very important. They start, as you might remember, with JP Morgan and other large banks on April 14th. And that's going to really help investors determine how to value these banks. Right now, they look very inexpensive relative to obviously earnings, but earnings could be revised downwards possibly after the first quarter results. But on a price to book and price to tangible book basis, when you move out the AOCI, which is the unrealized losses, the stocks look actually fairly inexpensive. But
that's the question. You said if you move out or you sort of look over here on these unrealized losses, everything looks great. If you look at the unrealized losses, obviously it's more complicated. Therefore, and given what you think may or may not come with regulation, these are either a screaming buy or they're still falling, right? I mean, and that's sort of the hard part to figure out.
That is true. And I would say that making that determination, believe it or not, it's going to be more on credit quality later this year and into next year if they're a screaming buy or they're going to feel more downside pain. I really don't think the deposit part of the AOCI issues will be the drivers of that valuation. It's really going to come down to credit like it has in past cycles.